Let me introduce you today's speakers. First of all, let me welcome Mr. Jamal Mecklai, the CEO of Mecklai Financial Services Private Limited, and he is one of the member of our National Advisory Committee of SME Chamber of India. And it's my immense pleasure to invite Aurodeep Nandi, the India Economist, Nomura, and he is going to give a very, very important and very useful presentation on India economy from pandemic penalty to pandemic premium. Friends, we are all aware that the SMEs have played very, very important role in this pandemic. They are, rather we should appreciate their efforts and their contribution towards Indian economy, even though there is a huge risk for their wealth and health. Since we are going to forex risk, before that, let us talk about their health and wealth. Many entrepreneurs have started their businesses after the April onwards or May onwards. Most of the SMEs have contributed their major product and services, particularly for the essential commodities, essential product or essential services, which is useful for the Indian community as well as Indian medical sector. We are aware that after the reduction of the import from the China, there is a huge impact on the most of the manufacturing industry and service industry, particularly large corporators. But SMEs have played very important role since the Honorable Prime Minister has given the appeal, and he has made appeal that we have to be vocal for local. So chamber is also supporting particularly for the SME sector, encouraging more SMEs to manufacture for local market, manufacture for global market. Since so many SMEs are face a lot of problem while supply chain management, they were not getting a raw material on time. The raw material raw material cost has increased. Labor problem was there. Most of the companies have not get back their regular manpower, and most importantly, they face a lot of problem for getting funding from their banks or particularly from their trade receivable from the various suppliers. Friends, particularly the SME sector is playing very important role, but they are looking for value addition services, level playing field from the stakeholders. Particularly, banks have played very important role during this pandemic. Government has also given a very good support to the SMEs for a survival, revive to survive. And somehow many entrepreneurs are not yet come on the proper track where they can manufacture the product, they can provide services because of the lack of manpower. Still, most of the companies are not started with the 100% with the capacity or manpower. They are struggling. Even supply chain management is not 100% working. But looking at the 3 months GST collection, output, industrial output, service output, and export promotion, I think SMEs have played very important role. So coming back to the today's seminar and webinar, we have to focus more on the SME perspective, how they can manage the risk while dealing with the forex. But I'm not going to talk about this subject because I don't want to steal the theme from these both the speakers or their internal information from the speaker. But I will give the platform to both of them to share their thoughts. And after their presentation, we will have a question answer. That time I will ask many questions on behalf of our participants. Participants are also joined many from the various parts of India, from Mumbai, Pune, Ahmedabad, Bangalore, Chennai, even Tamil Nadu also they are joined now. So with this word, I welcome all of you at this very important webinar, and a special welcome to Jamal and Aurodeep for this important webinar. So Aurodeep, I would like to, Dr. Aurodeep Nandi, I would like to invite you to share your thoughts on, as an India economist, particularly, what is your observation while during the pandemic? How many industries and SMEs have paid the penalty for that while not starting business, losing their customers, losing their export orders, losing their import orders, or also losing their businesses during this pandemic? And now, how much premium they are going to earn or they are going to lose in future? So, floor is open for you, Arodip. Now, your turn. Thank you. The best.
Thank you, Chandrakant. And to be honest, you shouldn't undersell yourself. A drop of practice is more valuable than an ocean of theory, which is probably what Jamal and I represent. Um, so, um, so typically, you shouldn't leave economists alone in a room with alphabets, because we tend to talk of V-shaped, W-shaped, many shapes in terms of the recovery. The question is, what is happening in India now? And let me go back to the cliche and say that I think we are in a double V kind of set, right? So there is a pandemic V that you're trying to get out of, right? So things got really bad because of the lockdown, and now you're trying to normalize. So that's a V there. I think the point which you alluded to, which is that things have been bad for a while now. This is Things have been bad before the pandemic struck. India's GDP growth was a shade over 3%. So you had the economy slowing before the virus made slow down. And so that's the broader V under which this pandemic V is constant. So, you can escape out of the pandemic V. And I think we are in the process of doing that. The big question is that, what happens in terms of escaping the bigger V? And that's going to be a little trickier. So to put it in economic jargon, the cyclical factors look great. Um, the structural factors, on the other hand, I think are trickier to to proceed. So, why essentially am I saying that there is a pandemic premium and a pandemic um, problem which we earlier faced? Um, you had a point where the number of cases were increasing, the number of deaths were increasing, as a result of which mobility was remaining quite low. Because of mobility remaining low, you had a drag on activity, you had a drag on consumer sentiment. Now, what's happened is that there's been an inflection of the pandemic curve. Cases are coming down. It's not because there are lesser number of tests. In fact, that's happening quite well. The number of deaths are coming down, and people have started panicking less about the pandemic. I mean, I stay in Mumbai. I go out on the streets. Most people are without a mask. There's a park opposite my house. People play all day there. So it's almost as if there is no pandemic. Um, the big question, of course, is that yes, there is a pandemic dividend that we are facing now, which is that mobility is increasing. Governments are being less risk averse. Lockdown situations are getting eased. But look, once the festive season gets over, I think it's really important to monitor the pandemic curve. As you can see in this chart, there is a slight blip over the past couple of days where the curve has just started picking up. Maybe it's a blip, maybe it's an inflection point one needs to see. But the point is, look, this entire crisis, the health crisis is at the center of it. So till you solve the health crisis, you're not really going to do much progress on the economic crisis. So that's kind of the pandemic backdrop. Now, one of the things which we've tried to do is use ultra high frequency data, data that we normally wouldn't look at. But because things are changing week on week, we are looking at really high frequency mobility data, employment data, energy consumption data, and we've kind of combined that all into an index, which is what you see on your left, the Nomura India Business Assumption Index. And the essential concept of this is that imagine that how activity was in end of Feb. Imagine that to be 100. Where are we now? And the answer is that we are roughly 85, 84, 85% of that activity. So there's still 15 percentage points in terms of activity that has to be bridged. The question is, what has driven this increase? And what you see is that there's been a rapid increase in terms of mobility. So it's a mobility-led recovery so far. People are venturing out on streets. People are going to shops. Factories are getting started. People are coming to work, and that's driving some of this momentum. I think what really worries me is the chart below, which is talks of the employment situation. And The thing that is troubling to me every week that I track this data is that the labor participation rate is trending lower than the pre-pandemic level. This is, of course, CMI's data. I mean, labor statistics are notorious in terms of um, in, in terms of consistency. But I think what's interesting is that labor participation rate was trending around 43% before pandemic. Now it's around 41%, which means that there is a good 10 to 11 million jobs that have just gone. They're lost, which gets back to the fact that the household balance sheets are in a lot of stress. It may not be visible on the face of it, but they are in a lot of stress. And you add to this the festive stimulus, right? So what essentially we try to do in this table is, we take away the concept of year-on-year growth, because that has seasonality, that's got a lot of noise to it. And we essentially try to see, okay, how much has each of these sectors, consumption, investment, external, industry, how much have they normalized? So 100 was the pre-pandemic normal, where are they now? And what we essentially see is that indeed, yes, consumption is picking up. It's currently around 87% of the peak output that it can produce, almost similar, in fact, to what it was pre-pandemic. But a lot of this has been driven by a pickup in car sales, in two-wheeler sales, tractor sales, leasing sales. All of this indicative of strong October festive demand. And it's two things, right? So it's the festive demand, and then there's also what we like to call in our jargon revenge buying. That is, you've been locked up for a very long time. You really want to buy the television that you couldn't buy for so long. So you've gone ahead and bought it. There are trucks roaming up and down the country, bringing that television to your doorstep. So you're creating higher sales, and that's reflecting across in data. On the external sector, it's also been good, but it's relatively weaker than consumption. I think for most of the sectors, the normalization is roughly 85 to 89% of normal. The sector that's really lagging behind is services. Services is roughly around 36% of pre-pandemic normal. And look, that's understandable, because services is essentially contact driven. There's a lot of transportation involved, and those are the biggest sufferers during a pandemic-like situation. And the thing that kind of worries me is that we might end up seeing fatigue before the finish line, right? So ideally, I would have thought that, as lockdowns got relaxed, these indicators should, rapidly go up and up and go back to pre-pandemic levels. Yet what we are now seeing is that even for indicators, sectors that, that have seen strong growth, say consumption, say industry, it seems to be plateauing before making up for the loss that has happened during the lockdown. So compare the loss that's happened during the lockdown. You see how much these guys have improved. At the far end is services, which is far off, around 50%, around 40 percentage points below pre-pandemic levels. But for the others, there seems to be some form of fatigue that is also setting in, which of course is worrying. But the fact remains that you are close to pre-pandemic levels. So this is essentially the pandemic dividend that you're slowly getting in. Post-October is going to be very interesting. You need to first see how much of the festive demand ebbs off. So once October, November gets off, how much of the festive demand, say for cars, two-wheelers, tractors, etc., remain. And secondly, we need to see what happens to the pandemic curve. Do cases go up? Because currently we are in the diametric opposite of the situation in Europe. In fact, I was talking to my colleague in London just before this call, and she was saying that their lockdown starts for 4 weeks tomorrow. So we are not in that situation. But hey, we're seeing that this kind of horror show does play out, where societies, where economies decide to go easy, cases pick up, and then another lockdown comes in. We are not there now, but I think that's a risk to the growth scenario going forward. But I think in terms of the broader drivers, and this is the reason why I would probably share some of Chandrakant's pessimism. One, the fiscal support in through this crisis has been quite limited for India. It's been limited to a little bit of free credit, subsidized credit, a little bit of free food. But on the whole, if you just plot it together, it has been much lower. And now that we're starting to get the growth numbers, countries that have had a stronger fiscal push actually have had a lesser growth hit. Countries like India, Philippines, where the fiscal support has been lower, have actually had a hit on growth, which is one of the drags on fiscal. And I know that on the face of it, there's a huge fiscal deficit viewing now. There is a lot of borrowing that's going to happen, and the government has announced a lot of stuff, announced a lot in terms of reforms, less in terms of actual cash stimulus. And I think the DEA secretary was there yesterday saying that the finance minister may announce a little bit more. However, I think that fiscal consolidation is it's like the mirror that you see in cars. Objects are closer than they seem. Fiscal consolidation might as well be quite close, because what's happened is this: revenues have had a big hit, be it in terms of corporate taxes, be it income taxes, disinvestment. I mean, you had a target of 2.1 trillion. We've hardly achieved 61 billion rupees this year. We are hemorrhaging as far as corporate and income taxes are concerned, as far as GST is concerned. The only indirect tax doing well is excise duty, and that's primarily because you've increased excise duty of petrol and diesel products. So overall, you've got a really tough situation on the fiscal side. So even if you need to, our projection for FY21 is 8.2% of GDP. Even if they need to maintain this 8.2%, essentially they need to start cutting expenditure. And look, we are already seeing that in the fiscal trends so far. The chart on your right is essentially how growth rates across various fiscal parameters has been in the first 6 months of this year. And actually, revenue expenditure is hardly 1% higher than it was last year. Last year, it was trending, and the year before, so in the first 6 months, it generally trends at 14% growth. It's growing at 1%. CapEx is contracting by close to 12%. So essentially, what the government is doing on the margin is trying to limit its expenditure in order to meet the fiscal target. Two things can happen going forward. Either they do this more, in which case actually your fiscal impulse on growth is going to be negative, or you borrow more, or you do both. And I suspect it's the third option that's likely to play out. Then let's not forget that underneath the carpet of moratoriums, of restructuring, of all this other non-recognition of the problem is actually a pretty huge problem that's just waiting for its turn to come up, which is the balance sheet crisis. Before the pandemic, you had what I like to call a triple balance sheet crisis. You had a crisis in bank balance sheets, in corporate balance sheets, and then in the last 1 or 2 years in shadow banking balance sheets, which means that you're in an economy where everyone is trying to deleverage. The problem which might emerge out of this crisis is we might have a quadruple balance sheet crisis, where household balance sheets are also affected because people have lost jobs, they have lost incomes, inflation is high, interest rates are low. So you will have a situation where possibly there can be non-performing assets building up also in the retail sector. And I think what's really interesting is the finding of Kamath Committee report, which said that, look, 71% of our banking sector debt is under stress. But hey, over 40% was already under stress before the pandemic struck. And I think this is a really worrying thing because, look, there will be eventually normalization. Look, I can argue that there is fatigue before the finish line. 1 month it does good, second month, it does bad, then it picks itself up. But eventually we'll get out of the lockdown loss. But once we start thinking about the slightly medium-term aspect, we're sitting over a really tough balance sheet crisis, and no one really knows how big this time bomb is, right? So we still don't know how big the non-performing assets bubble is going to be. RBI in its financial stability report 2-3 months back essentially put the number anywhere between 12.5% of loans to close to 15%. By the way, the very stressed scenario which they have of 15%, I think we're quite close to that scenario. On the shadow banking sector, we've not done the kind of sort of washing of stables that has happened in the banking sector. So we don't even know if the 6.4% which is there is adequately captures it or not. But the point remains that, look, you have a potential spike in NPAs that's going to come up, and you will have to find a way to deal with this in order to make space for growth. And all of this is leading to an inevitable drag in investment, right? The investment climate is getting worse. It was already bad. And what you're seeing now is that a lot of private players are just saying that, look, we were already facing a problem before the pandemic. Now output is hit. So we are really not interested in doing much. On the government side, as I just explained a couple of slides back, the fiscal space is very much a mirage because, it's very difficult in these situations to make fiscal space to do a lot more capex spending. And all of this is essentially just driven by whatever the government and public sector companies manage to do. So the investment situation is concerning, and the reason why it's concerning from a growth perspective is that it's things like these, a decade of no investments that starts affecting potential growth, right? So what will happen next year is, because we've had such a terrible year this year, arithmetically our growth rates are going to be quite high next year, but eventually it's going to settle down. And when that happens, I'm actually quite concerned that that the potential growth rate of the country then starts ebbing down. Because at the end of the day, potential growth is dependent on the capital stock of the country, the labor productivity, and the amount of and sort of the labor force. And all of those have been impacted by this crisis. Let's also not forget, and it's easy to state this, but there are huge social costs of the pandemic. There will be inevitably a lot of inequality that builds up. There will be a lot of retracement in terms of the gains that India had made in poverty reduction over the past decade. Within a year or two, you will probably see the number of people below poverty line increasing. This is something which the World Bank is also flagged. Now, the issue is that if you're now going back to poverty rates that were there, maybe 3 years back or 4 years back, the fiscal cost attached to that will also be high. There'll be more free food that you need to get out. Your NREGA programs have to be more. I was reading the other day in newspapers that the MGNREGA, the number of the people subscribing for that has increased, and it might be concerning that they may have to increase the budget of the MGNREGA. And I think those pressures on the social parts of the budget, of the revenue expenditure, I think are also going to start playing in. Maybe not this year, maybe even not next year, but eventually, of course. Which essentially puts us, at a very concerning platform as far as the ratings is concerned. And look, I think what happened during this year, as far as global rating agencies are concerned, is that they had a telescope with murky lens, so they really didn't know how bad fiscal was going to be. They didn't know how bad growth was going to be. So some of them, Standard and Poor, Fitch, decided to kind of give a little bit of lifeline. That all right, let's come 6 months down the line, and let's see how bad growth, medium term growth aspects are hit. How bad your fiscal is going to be. Mind you, 8.2% or 8.5% or maybe 9% of fiscal deficit this year doesn't necessarily mean that next year we'll be going back to fiscal consolidation, because if that happens, there'll actually be a big drag on growth. Whenever fiscal goes up so high, the way back is a much slow, protracted cycle that is likely to blow up your public debt as a percentage of GDP. We saw this during the financial crisis also. Fiscal deficit didn't immediately come down; it stayed sticky for a while, which means that there is actually a pretty high chance of next year to have a lot of this ratings fireworks happening. Now, and look, Jamal and I were discussing this 5 minutes into the call. Now, what is complicated the macro situation at this point? Excuse me for a bit. Thank you. So, what's really complicated the issues in all of this is that conventional macro theory just suddenly stopped working, right? I remember, 6 months back, we were internally discussing what should be our inflation projections, and we came to the rapid conclusion that if we are talking of growth dipping in the year by minus 11%, 10.8% or minus 11%, there is no chance inflation is going to be this high. It has to fall. And what's happened is that we've been proven wrong every month. Every month, we on the eve of a week before election, before the inflation print, we would look at the prices of the daily prices of vegetables, of pulses, of other food items, and we just see this roaring up. And this is also happening in the core. And the last print was 7.3%. The next print probably will remain as elevated because vegetable prices have spiked up, pulses prices have spiked up. And really the question is that, is this an aberration? What's really going on? Are there better days going forward? Are we going back to, the days of 9-10% headline inflation? You can see from the chart, the headline inflation has been, it's almost multi-year highs. The short answer, which we are saying, is probably not. Why are we seeing this? One, let's look at the food, and the reason why this is important is because, and I'll go on this onto the next slide, where is that when you have a high inflation scenario, essentially the space for monetary policy to act remains quite constrained, right? So it's really, from a macro perspective, it's really important to understand what happens next on inflation. And our argument is that probably it's going to go down. Now, why do we say so? In the case of food, a lot of this is being driven by two things. One, the escalation came because of lockdown-related pressures, so shortages in different markets, etc. But it persisted primarily because two things. One is you had unseasonal rains, and that has started affecting prices for vegetables. Now starts affecting the prices of pulses, and you also have certain lockdown-related idiosyncrasies. So, for instance, meat prices. Into the lockdown, I remember I remember my mom saying that we should not have chicken in the house because coronavirus goes through chicken. And we stopped having chicken. And then 2 months later, we are having chicken, lots of chicken. When we realize nothing happened. So, and you see this in the inflation prints. You see, meat inflation sort of go down and then sharply pick up. Spices inflation is pretty strong, and that's primarily because people think turmeric does wonders. So the point is that there's a lot of these idiosyncratic factors. But at the end of the day, we've had very good production. This is the first set of advanced estimate numbers for the Kharif crop have been good. We've had good rainfall, so the water reservoirs are good. So your Rabi crop should be okay. Globally, World Bank's latest commodity report essentially says that global prices, say of stuff like palm oil, which India imports a lot, of rice, where India is a key exporter, of sugar, all of these are likely to moderate in 2020. And essentially, if you're talking of vegetable pulses, the prices that you're paying now, in a month, in 2 months, you should have fresh stocks that hits the market. And typically, whenever there's been such flare-ups, it's accompanied by really sharp contractions. So on the supply side and the food side, I think these are likely to play out over the next year. And let's not forget, I mean, there is also a big base effect that brings the numbers down. The question is, what on earth is happening to coal, right? When growth is suffering so much, shouldn't there be a big correction as far as demand side inflation is concerned, core inflation? And the point there is that, so I think there's a mix of two things happening. One, commodity prices picked up, right? We hiked petrol, diesel prices, gold prices were high. Those were ramping up some of the parts of core inflation. There were also what I like to call pandemic-related inelasticities. So, what do I mean by this? Because of lockdown and now, unlocking, transportation has become much costlier. Buses, autos, taxis, actually on the CPI basket cost quite a lot. Education services, right? So if you go really into the subcomponents, you suddenly see online classes having very high price action. Now all of this is happening because what was earlier considered elastic as in, if prices are too high, people say no, thank you, we don't need it. That's changed over the lockdown, right? Because you can't do without those things. Similarly, the huge migration that's happened from urban to rural, you end up seeing the price of cook, the price of watchman actually picking up. And all of these, when you start adding them together, they are starting to impact overall core inflation. I mean, even cotton prices globally are picking up, so your clothing and footwear is increasing. Is the underlying demand side pressure in the economy, is that building up? The argument is probably no, or probably less. And you can see this in this 10% trim mean. So essentially what the trim mean does is kind of strips out all of these highly volatile bits. Says, all right, what's the core demand side? And actually that's trending much, much lower than what the headline is. And typically headline converges to the trim mean in a while. So I think going forward, we've got oil prices lower. Let's see what happens on gold. Some of these lockdown related inelasticities, these idiosyncratic pressures should eventually come down as lockdowns get off. And then you'll be left with the core goods and services that households demand. And let me take you back to the end of last year when core inflation started picking up. Core inflation started picking up before the pandemic struck, and that was driven by higher medical prices, b higher communication prices. Your tariffs on phones and internet were increased, and so it started off as a supply side phenomenon. And those supply side phenomena still persist till now. And once those start ebbing, we do believe that belatedly a lot of this growth damage that has happened will start to feed in terms of inflation, which is why we have a lower inflation trajectory going forward. What does this mean for the RBI? Now, I think what's happened is that fiscal has said, I can't do much. So essentially the whole policy deadlift has now gone on to monetary policy. And frankly, they've been doing a lot of great juggling. They're trying to keep the currency under control. They're trying to bring interest rates down. They're trying to push credit, and they're trying to prevent, a domino balance sheet crisis. And to some extent, I think the RBI has done a pretty decent job. Have conditions improved? Has there been transmission? The answer is yes. But it's not a great story for everyone. I think how successful the RBI is depends on where on the curve you stand. So, for instance, the spreads between 10-year and 1-year T-securities remain pretty high, almost at multi-year highs. I think I really like the chart below. The premium for weaker balance sheets. Typically, what happens in a crisis is that there is a chasm that develops between stronger balance sheets and weaker balance sheets. So if I'm a person with a strong balance sheet, I can survive the crisis better. I get access to better financing, and as a result of which, more financing comes to me. On the other hand, if I enter the crisis with a weak balance sheet, I was already having funding concerns before. Now those funding concerns are going to be amplified because people like stronger balance sheets more than weaker balance sheets in such a weak environment. And to that extent, I think there's been the RBI's actions have managed to cap the amount of spread that, say, a lower AA entity was paying versus a AAA, but it still remains quite elevated. And it's also showing up in terms of the credit growth numbers, which remain both at wholesale and retail levels have been dipping. So the work on monetary policy is still not over. So our projection is that there's still 50 basis points more of cuts to come. Essentially, they're being held hostage by this high inflation at this point. But once this inflation comes down, if we are correct about this, then there is a massive negative output gap, right? Growth has fallen. Our projection for FY21 is minus 10.8%. That is huge, right? So if the kind of negative output gap from potential to what it's tracking now would warrant much more easing. So we still have 50 basis points of cut to be delivered in Q1 of next year, from Q1 onwards. We earlier had 25 basis points for December, but given the way vegetable pulses prices are going, we've had to take out that call. But I think, look, the main lever is going to be unconventional policy, and this is a new elixir that EM central banks are tasting for the first time, right? And they're liking it. So expect more OMOs, more directly kind of soaking up the government's borrowing, more unconventional TLTROs, kind of trying to put money in places which are getting liquidity starved in an environment of broad of surplus liquidity. The external sector in all of this, of course, remains sort of the rare bright spot, although not exactly for the correct reasons, because much of this the surplus that we're seeing in current account is happening because domestic demand has fallen quite a lot. So your imports have come down. But look, so far, I mean, even transfers seem to have held up. Overall, we do believe that going forward, the best of current account is behind us. We still expect surpluses, so we are penciling in surpluses going into FY21. But it will start reducing. Flows seem to be okay. We should be getting good FDI. portfolios might be a little trickier, but overall, I think we have a pretty strong, if not unprecedented, overall balance of payments of roughly 78 billion now. And finally, I mean, given auspicious or inauspicious day, depending on what positions you have in the forex market, and who you support between Trump and Biden. Let me just conclude with two or three thoughts on that. One is, look, I think the blue wave, for all intents and purposes, is dead. Long live the blue wave. So the whole idea of there being a Senate, a blue Senate, is most likely not going to be the case, which sort of brings two scenarios at fore. And I really don't know what has happened over the past 1 hour in terms of results, but you can either have Biden as the president and the Senate controlled by Republicans, in which case some of the functioning is going to get trickier, some of the appointments are going to get trickier. More importantly, the fiscal package might be a little lesser because it will have to be passed by a Republican Senate. If it's Trump, then much of this expectation of dollar might be hit directly on the head, it remains to be seen what kind of fiscal package gets passed then. But look, if Trump comes in at again, then the power of the Republican Party to stop him is going to be relatively much limited. So whatever fiscal package he wants, he will get that. What happens for India? I mean, look, India and the US have had a number of trade skirmishes that have sort of imploded in the last few years. If Biden comes to power, we may get a resolution on some of these. We may get a broader trade deal. But I think it's important to know that both US and India seem to have driven into the road of protectionism. Be it India's Atmanirbhar Bharat, be it even Biden's Make in America, all of these are essentially inward looking. Although, I mean, if there is a strong fiscal package, if there is a strong infra package, then there will be some spillover to global demand, which is a good thing, of course. But an immediate evaporation of trade skirmishes, probably unlikely, even if there is a Biden presidency. In terms of geopolitical, I think there is still a lot of cooperation that's taking place that is likely to continue. Obviously, with Biden coming in, immigration would be an issue that would help India. But overall, I think on the trade aspects, it's going to be just a marginally, maybe a bit better for India and the country. So why don't I stop here?
Thank you, Dr. Nandi. You have very good elaborated these current situation and premium situation. So I have two questions in my mind. One is the point is how we will achieve the $5 trillion US economy, and what efforts to be put by the Indian industries, SMEs, and by government. Can you share your thoughts on this?
I mean, these are not innocent questions. This is a kind of question that probably deserves its own half an hour. But very quickly, I think two things.
So that's why I given to you. You have more time today.
Okay, so two things. One is the factors that have caused this kind of slowdown so far, right? So actually three things. One, you need to take care of the balance sheet crisis, right? So you need to clean up your balance sheets. You want to do it through a bad bank, you want to do it through any way. You will not get fresh credit into the system if you are living with zombie banks and zombie firms. So you need to clean that up. One. Two, I think there is a lot of reform that still needs to happen. I think one of the things that we end up doing is that we like announcing reforms because that's the exciting bit. And then when the boring bit comes of implementing the reform, it sort of the follow through isn't there. And a classic example of this is GST. So what needs to happen, say, be it farm, be it labor, be it any of these issues, it's about calibrated ease of doing business happening on the ground that actually helps firms grow up. I mean, I know India has done great in ease of doing business rankings, but I suspect, and you might be in a better position to tell me than I am, that on the ground it's going to be still a pretty tough job. So I think those micro factors really matter. The third aspect I think is just getting capital right now. You need investment in order to make any of this, because if you have just a lot of consumption, right, and consumption should be a product of something. Consumption should never be the target, because if you target consumption with limited amount of investments, you're leading to high inflation that will eventually come. So essentially you need to start investing. Now, how do you invest? You need to get foreign capital, and it's completely understandable why the government is fretting so much in terms of sovereign wealth fund, in terms of bond inclusion, because the whole idea is that let's get in more money. So I think more money, more reforms, and healthier balance sheets. Three pills.
Okay. See, the 2 points are there. One is, you said that particularly the efforts to be not only from the private sector, but it should be a government sector, government in the point of. But when I read in newspaper that if we have to achieve $5 trillion economy, we have to achieve the 11 to 12% GDP from next year to 2027 to 28. So we have to put more efforts, particularly from the industry perspective, agriculture perspective, production perspective, and the power perspective. Since you use the pandemic penalty and premium, so I'm using power for government, production for the industry perspective, performance from all perspective, and we can say the last P is performance and profit. So power, production, performance, and profit. Then only we can achieve that target.
Yeah, I mean, Chandrakant, I am actually a little skeptical. I get a little nervous whenever targets of especially something like growth is set up. It reminds me a lot of the socialist era of 5-year plans, where a group of sages would get around a table and say, next 5 years we are going to achieve this. I think at this point, the target isn't important. The point is that you've had problems, you have potholes in the road, fix them. You have problems in terms of implementation, get the house in order. Growth will come. You just need to get the right you just need to get the blood flow. You just need to get the arteries clean. The blood will flow.
Yes, but anyway, that's it. Now you said about the current the situation in the USA. Either Biden will win or Trump will win. That the total counting of the votes. But you say one very important point: if the Biden majority is having in the Senate, and the Trump is a president, it will be impact on the taking a decisions. All right, same thing you said. So decision making will be a difficult task for him. But what is a prospect India's perspective, particularly as an economist, who is beneficial for the India now?
So let me first clarify that I don't. It's going to be really difficult for the Democrats to get the Senate. So probably you're going to have a Republican Senate. Then if Trump comes in, then actually decision making will be quite smooth, because it's red. The White House is red and the Senate is red. In terms of who will be better for India, I think a lot depends on what you're looking at, because I think India-US relationship is often becomes paradoxical. On one side, we've got a lot of disputes happening on trade. On the trade aspects, I don't think that they're going to resolve very quickly if Trump comes in, right? Because the same issues are there, and the same points of view. Maybe if Biden came in on trade, there might be some concessions. India likes the whole immigration aspect, so maybe the immigration offer might make India go and relax some of the other offers that it has. So on the trade aspects, on balance, it could be that Biden is positive. But hey, even Biden, if you look through his manifesto, is quite protectionist. So do not expect a complete reversal of what Trump trade policy is concerned. On geopolitical, I think there is a pretty strong matching that's already happening. It's probably going to increase regardless of who sits in the White House, because we've got skirmishes happening with China, because geopolitically we would like to be closer to the US. There might be some small wrinkle in terms of Biden's views, his administration's potential views on, say, Kashmir or on minorities, etc., which might be a little bit of an irritant, but really not much there. So I think on immigration, on trade, probably Biden will be better. On geopolitical, I think I think that it's already a pretty strong relationship.
Okay, stay with us. There will be few questions are coming now. Coming to the point about the very important speech by Jamal. We are aware that the small and medium enterprises have largely relied on the traditional banks to supply the majority of the financial service requirements, from credit to corporate payments. The banks has been the hard things of the very much in control. But the point is now the global financial crisis, or the situation during the pandemic, it's difficult. It's hugely faced by the SME sector, and the forex management risk is very, very important for SME sector. So for that purpose, I would like to invite the Jamal to come in to share his thoughts on particularly how risk can be managed. Jamal, what is your
Thank you, Chandrakant. And Aurodeep, I must thank you as well. People talk about economists, economics as being the dismal science, but you made it very, very, it was dismal, but you made it very, very interesting. In particular, all of the sort of the high-speed data that you were taking. And there were a couple of things you talked about, which I'm actually going to incorporate into my talk. Which my talk is, I always say, my first thing I will talk about is what is going to happen to the rupee. And the reason I ask that question is because I have an answer. My answer is I don't know, right? And nobody knows. There may be people who will tell you this or that or the other, but the truth is nobody knows, right? The reality is it's God knows in whose hands, but certainly I don't know. Nobody knows what's going to happen to the rupee. Now, we can talk a lot about different possibilities. I mean, like we've seen in the last 6-8 months, when the rupee fell to 77, everybody said it's going to go to 80, right? But sure enough, it didn't, as it hasn't, the way it works over the last 15 years, the rupee stays steady for a long time, maybe strengthens a little, then crashes. Again, does the same thing. Again, it does the same thing. So from 77, it's recovered to about 73. People were thinking, my God, what is going on? And now it's starting to soften again a little bit. Now, the issue is, why did the rupee strengthen from 77 to 73, right? Well, clearly, our trade deficit has fallen, right? Because the economy is in such bad shape that imports are very low. But more important than that, I believe, was the fact that there have been a lot of inflows, both direct investment. A lot of money came into Reliance, but there has been ongoing direct investment because interest rates are so low overseas. A lot of banks, etc., have been raising capital. And plus, because interest rates have been so low overseas, and because RBI has tried to bring rates down, but this is what Oro and I were discussing, inflation doesn't look like it's going away, in my view. So rates are going to stay up. So that means portfolio flows are going to continue, and they have been continuing. I also read a very interesting article somewhere recently, which said that, there is so much capital in the world, and huge amounts of it, more than $1.5 trillion, is sitting unused in the private equity space. And the private equity, money has no morals. Private equity just goes where they think there is a market. And whatever the current condition of the economy, the reality is India, China, all of Asia is actually the market of the future. So over time, it is likely that that money is going to keep coming in. Now, whether it comes in immediately or after 2 months or 6 months or 5 or 2 years, the fact is that is primarily going to drive the rupee. So that is one of the major forces that has been keeping the rupee afloat, and it is going to remain in play, right? Now, what could turn it around, right? A, if there is some major crisis globally, if the US stock market, let's say Trump wins, and that's even crazier than he has been, and the stock market tanks. I don't know that any of the above will happen. But if the global markets tank, people start saying, oh God, the world is too risky, they will pull money out of everywhere, including India. But there was another point, and this is the second point that I'm going to touch on what Auro said. He mentioned, and I think I never thought about it, but I think he's correct, is that because growth is going to be so difficult in India for the next few years, and the fiscal deficit is going to be very difficult to control, it's conceivable that the rating agencies might decide, today they're cool, but they might decide, Baba, I got a rate, turn it down. Now, if that happens, we could see, because a lot of the money that comes, portfolio money that comes in to India can only come if the rating is at a certain level. So if something like that happens, that's another thing that could crash the rupee down. And then, of course, there could be local events, So, as I said, I don't know. I can sit and talk about all the different angles. I'm not an economist. I can't talk as much detail as Auro. But the truth is, there is no way of knowing what is going to happen when, right? So the only honest answer to the question, what is going to happen to the rupees, I don't know. And if you are, I assume many of you are running businesses where you have FX risk. I think that is very important for you to accept and acknowledge that, Baba, you don't know what is going to happen. Now, in life, if you don't know what is going to happen, you have to be very, very careful, right? So, in other words, you have to really look at first you have to look at what is my risk? How do I identify my risk? And then we will come to how you manage your risk, right? Now, I've been in this trade forever. I'm older than probably any three of you to put together. But I've learned a few things. The first thing in risk management, to me, I have three principles of risk management. The first is on risk identification. See, despite the fact that this recent pandemic has actually made a lot of people wonder if their business is going to continue. But in general, most companies are going concerns. So in other words, if you have exports or imports, and we're in November today, November 2020, the truth is you are going to have exports and risk in November 2021, November 2022, and forever, assuming you're an exporting business. So what that means is, first question is you have to decide, how far out am I going to look at my risk? What is going to be my tenor of risk identification? Now, that depends absolutely on the kind of business you're in. See, IT companies have got long-standing contracts, and many of them now identify risk out to 24 months, right? They've been all over the block. They started at 12 months, they went to 5 years, they came back. But now generally the large IT companies identify, and pharma companies identify risk out to 24 months. Why? Because they've got these ongoing contracts. They don't have to worry. Their margin is not under any sort of pressure. Now, if you were in let us say, a commodity company, where you're selling yarn, or you're selling something where the product price is very dependent on dollar rupee. It's a very competitive market. You have no choice. You can only look 2 or 3 months. So the first thing you have to do is you have to understand your business, which all of you do much better than I would. But you need to determine to what tenor am I going to look at risk. Is it 3 months? Is it 6 months? Is it 12 months? Is it 24 months? Depends on your business. So that's the first and very critical step. The second step, and I'll come back to what I said before, which is that the truth is you don't know, I don't know, nobody knows. So ideally, you really want to stay as far away from the market as possible. So what that means is if you want to take as little risk as possible to market. Let's say you have got exports of 80 crores, right? And you have imports of 20 crores, right? Okay, so you have a natural hedge. So you need to make sure you use the natural hedge to the maximum extent possible, right? So if you are able to set off 20 of the imports against 20 exports, your risk you're taking to market is only 60, right? So that's very important. Now, what a lot of companies do, because people have also learned over the years, right, is they use the EFC account. Dollars come in, they use that to pay for the imports. Now, that's good from a point of view of limiting the risk, but there is actually a way to do it in a way in which you can make money. Instead of doing that, suppose you paid an imported spot. Let us say you had, $120,000 import that came today. You pay it at spot, and at the same time, you sell $120,000 3 months forward, right? So what happens? Both the import and export are at the same spot rate, and you've got 75 paisa premium in your pocket. So this is risk-free earnings. So in the same example, if let us say you have, I said, 20 crores of imports. 20 crores of imports is about $3 million, let us say. So $3 million is 30 lakhs times 0.75. That is 20 lakhs of rupees risk-free in your pocket. So that is something that, there are some, accounting issues, et cetera, that may come in, but there are ways to deal with that. But this is very important because it is straight gain and it is reducing your risk. Right? So I said the second rule is you manage your risk, your natural hedge, or any risk you can structurally as much as possible. The third rule, of course, is the big one, right? Okay, so now I've got these 60 crores of exports that are coming in at different times. What do I do? Right? I don't know what's going to happen to the market. So should I just sell? Yes, that's one possibility. One thing you should definitely not do is not hedge at all, right? Because if you don't hedge at all, now sure, sometimes the rupee falls by, 5 rupees and you make a fortune. But the reality is if you stay completely unhedged, you are carrying 100% risk and you really have no idea what you're going to get, right? Now, the alternate or the flip side of that is, okay, let me just hedge everything. That's not a bad approach. The only problem with that is, A, you don't know exactly what your receivables are going to be. And B, the truth is that the rupee does depreciate sometimes, right? And if you hedge, you could lose a lot of opportunity. Right? Sorry, what I said before, so what am I saying? If you hedge, you would lose a lot. You could lose a lot of opportunity if the rupee does indeed depreciate. What I was saying before was incorrect, where I said that if you do nothing and the rupee depreciates, you would lose money. You wouldn't. You'd make money. But if you do nothing and the rupee appreciates, which it has done and does regularly, you would lose a lot on your exports. In point of fact, we've do a lot of numbers. And over the last 10 years, the worst appreciation of the rupee on a 12-month basis was about 13%. So if you're staying unhedged and you're unlucky, you would lose 13% on your exports. Interestingly, on a 3-month basis, the worst appreciation was as much as 9%. So you really can't afford to stay nanga for any length of time. So what do you do then? Right? How do you really take it forward? Well, like I said, we don't know the market, but because we've been doing this for a long time, we've developed a program, it's a systematic hedging program. It's a little like an SIP, but it isn't really. It's not exactly like an SIP. So what you do is, let's say for argument's sake, I've got say I've got $500,000 coming every month for the next year, right? So I have $6 million coming in, right? I could sell everything today, and let us say I would get an average price of 76 rupees, right? I'm just picking some numbers. So the first thing we would do is we would say, okay, I want to draw a line. I want to draw a risk limit. So let us say I will draw the risk limit at 74 rupees. So now I must have a program to make sure that the 74 will be delivered, even if the rupee goes to 70, right? Whatever happens, I must protect that. So how do I do that? Well, the first step is I would hedge a certain part on day one. And then every day just monitor where the market is, right? So I've hedged certain part at 76 average forward rate. Now, if over the next week or month or 2 months, the average forward rate goes up to, let us say, 76.50, I'll hedge a little more. If it goes up to 77, I'll hedge a little more. Now, at any time, if it turns around and the rupee starts to appreciate and it starts threatening my 74 level, I will exit before it gets there. I mean, there's a few technical tools we use, but that's not for this, it's too complicated to explain here. So we have been running this program for about 10 years now for several clients. And its performance, now it is not going to get you the best rate, right? But for sure, you will be protected from the worst rate. In 10 years, this program has never breached the risk limit, not in a single month, right? And it has been tested against lots of different treasuries. It has outperformed 152 out of 162 treasuries. To my mind, it's the only way to go, right? What you've got to do, though, is, as I said, and this is the most difficult part, is you have to learn how to not think about the market. See, most people have been running a business, you can't help it. CNBC talks about the rupee, Standard Chartered Bank, Nomura tells you something about the rupee. I don't anymore. But, people talk about the currency all the time. You're thinking about it, even though it's a waste of time. It makes no sense to think about something you can't control. So what you really need to do, and this is the most difficult part of my job, is to convince companies, Baba, chhod do yaar. Just try. I used to tell people, hey, throw your Reuters screen out, or you don't need that. You only need it to see the rate when you're going to hedge, right? So the trick is to learn how to do that, and frankly, it only comes if you do it. I have one client who's been using this program for, I think, since 2009 or 10. Right? It's quite big, actually. He's about $200 million. Now, he basically follows it blindly. Aankh band karke. So in March this year, right? And one of the things about this program is because we are constantly hedging. Like I said, it's like an SIP. So at any point in time, you'll have 70-80% of your portfolio hedged. So in March this year, when the rupee completely crashed, I called him, and he lost a fortune, right? And not only did he lose opportunity, he lost cash because he had a lot of contracts that were canceled. He's in the textile trade, big player, but he had 3 or 4 months of sales were canceled, and he had covered. And the rupee was so much weaker. I can't remember the number, but he lost a fortune. I felt really bad, and also felt very nervous that I've got a good client who might want to leave. But he said, look, I understand. It happens. I have made money over the years, right? So he's my best client because he has learned, and he really aankh band karke follows the rules. And again, this is not any magic, right? It's just we've been doing it for a long time. And the reason it works, like I said, it beat 150 out of 160 treasuries. The reason it works is because of the risk limit, of the stop loss. there are very few companies, certainly in the SME sector, very few companies who will A, set a stop loss, and B, most important, when the stop loss is hit, they will follow it. I mean, suppose you see the market going against you. You want to get 74. It's come forward, it'll come down to 74.25. Your naturally, tomorrow it'll get better. It'll turn around. You will talk to your banks, you will talk to everybody. And basically, the real difficulty with thinking about the market, there's a lot of information, but you will try to, you will look for information that will suit you. I have clients who are importers who are always asking me about, but the inflows are going to keep the rupee strong, right? I have clients who are exporters who are also always saying, but the growth is so bad, the economy is so bad, the rupee has got to fall. So I'm saying, I always tell people, Baba, iske baare mein baat karna hai na, to come out in the evening, let's have a drink, and we can talk for hours about the market because it is interesting. But you don't use your market view or my market view or anybody's market view to run your business. So that's basically, our approach and what I think you people should follow. It's for exporters, it's very, very clear. For importers too, you need to follow some kind of structured process. The main thing is, as I said, listen to the economists for enjoyment and gyan, but don't listen to anybody about the market. Thank you.
I think today's webinar gave me two messages. One, listen to economist, and second, work with a specialist. Specialist like you in a forex, and particularly how to avoid the risk while maintaining or managing any type of foreign currency. Anyway, it's a very interesting topic today, and rather Dr. Nandi has also given very good highlight. Dr. Nandi, do you have any question related to your perspective to Jamal?
Who were you asking?
I'm asking Dr. Nandi. Do you have any question to Jamal?
No, I mean, this evening's entertainment, not much, I think, but I would be interested to hear.
Or you're thinking to meet on a drinks and then have a chat?
So that's exactly what I had in mind, which is that what about the view? I know, and this is going to be more, where are you seeing the rupee go? How much do you think this election really matters for the rupee? So what's your trajectory for the rupee?
See, genuinely, I really don't know, right? And see, one of the other problems, right, is when you start thinking of world events, right? You think about things that you want, right? So I, for one, would like to see Trump lose, okay? So that will influence my thinking and that will influence my view. The truth is, I don't know that Trump is going to lose, right? Now, but picking up on the early part of the conversation, if Trump loses, Biden wins, and the US Senate is still with the Republicans, it will just get completely jammed, right? So one of my concerns has been, and this is, I call myself a Buddha in a brightly colored shirt, right? One of my concerns has been since 2008, it is not a new concern, that you can't keep pumping in money into the market forever. But 2008 to 2020, right? The central banks have been pumping in money, right? Asset prices have just gone up and up and up and up and up. Inequality within countries has gotten wider and wider and wider. In fact, that's one of the reasons Trump came in, I think, right? Now, how long can this go on, right? So every time there is a collapse, right? I think this is it. Like in 2015, because there was some fear that they will start raising interest rates, the market fell quite sharply. Is this it? In 2018, they thought they were going to raise rates. Again, Again, after the pandemic, see, nobody knows what is the future of there, right? So I guess what I'm coming to is at some point, maybe not, but at some point, there has to be a collapse in global asset prices.
Okay.
I don't know when. Now, when that happens, it will go risk very loudly off and the rupee will collapse, right? But wo kabhi hone wala hai? Mujhe pata nahi, you know. And really, I was very pleased because I hadn't thought about that point you made about the rating agencies, you know, because that could come sooner. That could come in a year and a half. And that could also lead to the downside, you know. See, I mean, markets are simply supply and demand, right? And there is just no demand for dollars, right? Because imports are down in the gutter. So, sorry, I don't have an answer.
Okay, Jamal, the point is, when we work with a specialist broker, he helps us for a company for examining the hedging strategies for the transactions or exposure, such as the forward contract or currency options. There are, in forex mitigation, there are three types of forex risk. One is a translation accounting exposure, second operating and economic exposure, and third transaction exposure. So at this point, I want to understand from you how this will be beneficial for SME to buy and sell foreign currency, or to look at the saving the money annually, because most of the companies are now facing a big problem. They are losing a lot of money on the they hedge foreign forex whenever they want, but they do at a time only. Sometimes they don't want to wait for a half. How you said today, how much money I want, I do done a hedging. Second day something, and but somehow some on the entrepreneurs or SMEs or the companies are here, they do immediately. So what is your observation, or what is your message to on this point?
See, so you're talking about people who do immediately because they need cash, right?
Cash.
They discount the bills and need cash. I understand that. But see, the fact is, again, let's take a example, right? Let us say there is a company that's got like the 200,000. They know their business. 200,000 a month is coming every month, right? He knows though that when that 200,000 comes, he can't hold it. He has to discount it. But what he can do is he can 6 months before or 1 year before, he can manage the risk on this 200,000, right? So there will be some forward contracts and he can use the forward contract to discount, you know. But again, what I'm saying is that you need to be very clear on your business and identification. So you need the cash, of course you need the cash, but you want to try to two things. You want to try to get some benefit from the market, but equally you want to make sure, see, my whole approach is from the risk side. As I said, today, if you are running a business, you are carrying risk forever. So I want to reduce that risk as much as possible. And the good benefit, at least of this program we're doing, is you can get some value. You know, as I said, this program, over the last 10 years, on average, it has beaten staying unhedged. See, what you're saying is, Baba, I need the money, so I'll just take the money and run. It has beaten staying unhedged, if I remember correctly, by 0.84%. Right? But you just have to, the trick is to follow it. It's not, it sounds much more complicated than it is. Right? Okay. One other point you were talking about is accounting risk. Now, see, sir, I would say you can either manage the accounts or you can manage the cash. And I think we should manage the cash. In fact, Narayan Murthy, many years ago, said it very eloquently. He said, cash is real, profits are an opinion, right? And plus the accounts now, if you opt for hedge accounting, right? All listed companies have to do it. A lot of companies are doing it. Then that comes out of your P&L and it's not an issue.
Okay. Another point is assessing the changing dynamics of the foreign exchange market. That is the most important aspect we have to. Another very interesting point I would like to ask Dr. Nandi. that since there is a huge, the awareness for the particularly the presidential election going on, the voting going on, vote counting is going on. But looking at today's market, capital market, I think 350 points are up. So what is your observation that it's a impact of this presidential elections result or a benefit towards the India's perspective?
Look, over what happens in markets, so I'll sort of, tuck inside Jamal's umbrella, which is that what happens to markets over the next couple of days is it's going to be really tricky to predict or to attribute that this is causing that. I think there is a certain afterglow of good October data that is there, right? So you've had good elections, you're getting good auto sale numbers, and it's really difficult at this point of time to filter out how much of that is festive, how much of that is pent up, how much of that is underlying demand. So for a long time you had markets performing well and economic data not performing well, and that data is now starting to show up. So there is some optimism there. I think a lot is going to depend on sort of what emerges in terms of the scenario. So maybe over the next 24 hours, 48 hours, if Trump does win, there might be a concern that dollar may not be as weak as it could. So there might be some reaction to that. But beyond that, I mean, one really.
Let me tell you a very interesting story on this subject. See, this election and the possibility that Trump will say, I'm not accepting the results, etc., etc. There are people who feel there could be a real crisis. Correct? Now, as I say, as a starting point, you can't judge the market. But when there is a real drama, it is foolish to even think about it. Right? I'll tell you a story, true story. This was a long time ago, 1987. I had just come back from the US in 86. I had started this business. Bright shirt, ek saal mein, I was already Guruji. Right? In October 1987, when Wall Street crashed, right? There must have been, I don't know how many people calling me, what is going to happen to the dollar? What is going to happen to the dollar? I said, Baba, exactly what I said. Look, in those days, I used to think I knew the market. But I did know one thing, that when it's a completely unprecedented event, you can't know. No one can know. But people kept asking. So what to do? I went crazy. I went downstairs to smoke. I was smoking a cigarette, and across on the street, the side was the chanawala. He came up to me and said, Saab, 50 rupiya do. I said, Baba, main soch raha hu, chodo. I was smoking. And then I called him. I said, 50 rupiya chahiye? He said, haan, Saab. So I said, bolo, dollar upar jane wala hai, niche jane wala hai. He said, Saab, mujhe kya pata? I said, bolo, paisa chahiye to bolo. He said, haan, paisa chahiye. So he told me something, I don't remember what. I gave him 50 rupees. I went up and I told everybody exactly what he had said. And I don't know whether it was true or not, but when the world is completely crazy, the chanawala's view is as good as anybody's. So it's a true story. I'm able to tell it now. I didn't tell it then. But it's true. So if it gets crazy in the US, whether the dollar will go up or go down, I feel stocks should fall. My gut feeling, right? Because people will say, my God, is this a country or a banana republic? But you never know. Fed will keep pumping money in and it'll go up.
Anyway, so it was a very, very fruitful and very nice discussion. I hope let us think about the future of India's economy, future of Indian SMEs, and we should pray to God not to pay more premium for any type of but particularly business point of view or a wealth and health point of view in future. So pandemic has taught us many lessons, because that the SME sector never have decided or planned for 3 months and more. So now 6 months are over, and many people are some people are on the road, some people are in the vehicle, or some people are at home. So the point
It's a tough time.
Yes, it's tough time. So we have to focus on more how to mitigate our risk, how to develop our connectivity, how to utilize the new concept, new ideas for improvement of our business activity, and mostly how to take advantage of the products, services, and the facilities available made by banking sector, government, stakeholders, regulatory bodies. This is the right time. And I suggest all the SMEs, those are listening to us and those are going to listen in the after this program in the recording. I suggest take advice from the specialist, associate with the chamber for a business growth and expansion, listen to the economists for a better future of their businesses. With these words, I'm thankful to both of you, Jamal and Aurodeep, for sharing very, very fruitful and very knowledgeable talk today. So, and look forward to hear from you. All the best to you,
sir.
and
Thank
good
you
night
very
to
much.
you. Thank you very much. Looking forward to more input of the suggestions and knowledge sharing sessions. Thank you very much, and good night to you.
Thank you. Thank you very much. Good luck. Bye.